Okay, we're going to look at some journal entries and postings that you'll be doing in this chapter when you do the accounting assignment. So here's your journal page that you'll be looking at. There's some transactions already done. Insurance, we've got the insurance bill and we have not paid it yet. We got the telephone bill, have not paid it yet. So those go into accounts payable. And let's look at this one on the 5th. Accounts receivable is being debited for $94 and two different income accounts are being credited for $44 and $50. So that means a customer has received services on account and they have not paid us yet. So let's go and look at that posted. So accounts receivable, as you can see, accounts receivable, we're looking at the first one here, is being debited for $94. And then its new balance is calculated, which it had no prior balance, so it's $94 balance. When we go and look at our income accounts, nil service income is credited for $44 and has the $44 balance. Hair services income is credited for $50 and has a $50 credit balance. Alright, so now after this customer charged on account, they are going to pay us on the 10th. So we're going to talk about the undeposited funds account. This is the account that's a temporary holding account for all cash and checks received from customers. Any checks received or payments received on account from a customer, or any cash sales receipts that you receive is going to go into the undeposited funds account temporarily until it is time to make a deposit. So if you make a deposit at the end of the week or you make a deposit at the end of the month, then we would transfer funds. But let's go ahead and look at this journal entry. The undeposited funds account is being debited. So normally when we receive a payment from a customer, we are thinking we should debit cash or checking. But in this case, we are going to use the undeposited funds account, which is what QuickBooks uses. Then we are crediting the accounts receivable account, which decreases the amount the customer owes us. So let's go look at that posted. And we are debiting it for $94, and so now it has a $94 balance. Accounts receivable, we credit the account for $94, and that leaves us with a zero balance because the customer has paid us. So let's do one on our own. Let's do a cash sale or sales receipt. So this is a cash register sale. So, someone came in and they got some hair services from us, and so we are going to receive that cash payment and put it into undeposited funds. And that's going to be $55. And what account are we going to credit? We are going to credit the income account. Okay, so now let's go and post. We are debiting the account for $55. So we need to calculate a new balance in the account. We are increasing the account, so that's a $149 balance now in undeposited funds. Credit it for $55. That is what we have earned. And now the new balance, we calculate a new balance in the hair services income account, and that would be $105. Okay, so let's skip some time now, and let's say that we are at the end of the month, on the 30th, and we are ready to make a deposit into the bank. So now what we're going to do is transfer from undeposited funds into our checking account. So we will debit checking because checking is going to increase. And we will credit undeposited funds. It's an asset account, and crediting it will decrease it. So checking is debited for $149 and undeposited funds is credited for $149. So let's go and post to checking on the 30th. So we need to calculate a new balance in the checking account. So we are going to add $149 to the $2,500 balance. So if we credit the undeposited funds account for $149 and calculate a new balance, it had a debit balance, so that means that it is zeroed out. So that's how our sales, our cash sales, and any cash received will work, and how a deposit will look.